Today we're diving into the fascinating world of investment strategies, specifically focusing on the age-old debate, U.S. versus international stocks. The article we'll be referencing highlights historical cycles of outperformance between these two asset classes.
A crucial question for any investor, indeed. Understanding these cycles is key to building a robust and diversified portfolio.
Absolutely. Many investors have witnessed the recent dominance of U.S. stocks, but history shows a different picture, doesn't it?
Precisely. While U.S. stocks have significantly outperformed international stocks over the past decade, this hasn't always been the case. These cycles tend to shift, creating opportunities and risks depending on the timing of your investment.
So it's not just about picking a winner, but understanding the cyclical nature of these markets. The article mentions that U.S. and international stocks tend to take turns outperforming each other. Can you elaborate on the historical context of these cycles?
Historically, we've seen periods where international stocks have significantly outpaced U.S. stocks, and vice versa. These cycles aren't predictable, and their duration varies considerably. The chart referenced in the article visually demonstrates this ebb and flow. It's a powerful reminder that diversification is crucial.
So even though U.S. stocks have been strong recently, history suggests this won't necessarily continue indefinitely?
Exactly. Past performance is not indicative of future results. Relying solely on recent trends is a risky strategy. Diversification across different markets mitigates this risk.
The article emphasizes the importance of diversification. How does diversifying between U.S. and international stocks contribute to a more robust portfolio?
Diversification reduces overall portfolio volatility. When one market underperforms, the other might offset those losses, leading to a smoother investment journey. It's about managing risk, not necessarily maximizing returns in the short term.
So it's a risk mitigation strategy rather than a market timing strategy?
Absolutely. Trying to time the market is notoriously difficult and often unsuccessful. Diversification is a far more reliable approach to managing risk.
The article mentions that current valuations in international markets might be lower. How does this factor into the investment decision?
Lower valuations often present attractive entry points for long-term investors. While the current outlook might seem less promising, lower prices can sow the seeds for future growth. It's a matter of perspective and long-term investment horizon.
So the current underperformance of international markets could be a buying opportunity for patient investors?
Potentially, yes. However, it's crucial to conduct thorough due diligence and understand the underlying factors driving those lower valuations.
The article includes several comments from readers. One reader points out that international investing hasn't been a net winner for U.S. investors since the early 1990s. What's your take on that?
That's a valid point, but it's important to consider the nuances. Lumping all international markets together ignores the significant variations in performance across different countries and regions. Some markets, like India and China, have shown tremendous growth over the past 2 decades.
So a more nuanced approach is needed, focusing on specific markets rather than broad generalizations?
Precisely. Careful selection of international markets is crucial for success. It requires in-depth research and understanding of individual market dynamics.
Another reader suggests that the lower valuation of international stocks might be due to sector allocation differences compared to the U.S. market. What are your thoughts on that?
That's a very insightful observation. Sectoral differences can significantly impact valuations. Normalizing for sector exposure can provide a more accurate comparison of valuations across markets.
And what about the comment suggesting that increased skepticism towards international investments might signal a potential turning point?
That's an interesting contrarian viewpoint. When many investors are pessimistic, it could indicate that the market is undervaluing certain assets, creating potential opportunities. However, it's not a foolproof indicator.
The article also mentions that many large U.S. companies have a significant global presence, providing indirect international exposure. How does this factor into the discussion?
That's a valid point. Owning shares in multinational corporations provides some level of international diversification. However, it's not a substitute for direct investment in international markets. It's a supplementary factor to consider.
And what about the comment referencing an article about low global stock market correlation?
Low correlation between markets suggests that diversification benefits are enhanced. When markets are less correlated, the likelihood of simultaneous downturns is reduced, further strengthening the case for diversification.
Given the complexities involved, what advice would you give to investors considering international investments?
Thorough research is paramount. Understand the specific markets you're considering, their underlying economic conditions, and potential risks. Don't rely solely on past performance.
So a well-informed decision requires a deep dive into individual markets and their unique characteristics?
Absolutely. It's not a one-size-fits-all approach. The optimal allocation between U.S. and international stocks depends on individual risk tolerance, investment goals, and time horizon.
What's the importance of a long-term perspective when considering this investment strategy?
A long-term perspective is crucial. Short-term market fluctuations should not dictate investment decisions. Focus on the long-term growth potential of your portfolio, accepting that there will be periods of both gains and losses.
So patience and discipline are key to successful long-term investing?
Absolutely. Emotional decision-making can be detrimental to long-term investment success.
Many investors are hesitant to invest internationally due to perceived risks and complexities. How can these concerns be addressed?
Education and research are key. Understanding the risks involved and developing a well-diversified strategy can mitigate these concerns. Consider using mutual funds or ETFs that provide broad international exposure.
So utilizing professionally managed funds can simplify the process for investors who lack the time or expertise for individual stock selection.
Precisely. These funds offer diversification and professional management, making international investing more accessible.
When should investors seek professional financial advice regarding international investments?
Seeking professional advice is always a good idea, especially for those who are unsure about their investment strategy or risk tolerance. A financial advisor can provide personalized guidance based on individual circumstances.
So professional advice can provide a tailored approach based on individual needs and goals?
Exactly. It's a valuable resource for navigating the complexities of international investing.
To summarize, the key takeaway is the importance of diversification, right?
Absolutely. Diversification is a cornerstone of sound investment strategy. It's not about predicting market cycles, but about mitigating risk and maximizing long-term growth potential.
And this applies not only to US versus international stocks, but also to other asset classes as well.
Precisely. A well-diversified portfolio should include a mix of asset classes to further reduce risk and enhance returns. Ultimately, the decision of how to allocate between U.S. and international stocks is a personal one, dependent on individual circumstances and risk tolerance. However, understanding the historical cycles and the benefits of diversification is crucial for making informed decisions.
That was a great discussion. Thank you for your insights.